I think, in terms of valuations between, so stepping back, valuations between payment companies and SaaS companies. So in my opinion, and I'll leave these guys upon as well, I actually think both tend to trade for pretty good prices in today's market. You tend to look at pretty premium valuations across both sectors. So, I think you're not going to see a major change, a sea change, sort of, bringing on the payments revenue. In order to sort of optimize your valuation, I think you want to make sure that you're keeping, it sort of sounds silly, but keeping really good books and records of exactly what part is payment, what part is your SaaS, what the retention rates are on both. You want to make sure that you have a really, really strong sort of religious core of customers where you're doing the payments for them and you have a great sort of referenceable base with them. And then, I think to sort of maximize the valuation of folks like us, you want to make sure that you're sort of pitching it the right way, right? Like look at, for these 30 customers, I've offered payments, I have same customer growth of Y. If I expand this across my whole customer base, I'm going to have X amount more revenue. My TAM is this big. If I offer payments across that whole TAM, here's what I could be like. So I think you want to keep really good books and records and then sort of pitch it the right way.
Yeah, so hopefully when a SaaS company goes into payments, their total addressable market, their TAM increases. Hopefully the revenue and gross profit per customer increases. Hopefully their profitability increases. Those are the reasons why going into payments makes sense. It's not because it's magic. It's not because the valuations change. It's because it hopefully makes it a better business from a fundamental standpoint. And the way we look at the world is fairly simple, which is what makes revenue more valuable or less valuable is how predictable is it and what's the gross margin on it. And so if somebody brings in a bunch of payments revenue with a lot of payments costs, we're going to view that revenue as less valuable than their SaaS revenue. But that's because of the flow through margin. It's not because one is intrinsically better than the other. And there are situations where the payments revenue can be more valuable than the SaaS revenue, and situations where the converse is true. So it really depends on sort of the business fundamentals. And the advice I always have for people, and it sounds trite, is good business decisions lead to good valuation decisions, and sort of vice versa. And if you do things that are bad business decisions because you think they're going to have some short-term valuation magic, that'll work occasionally. But for the most part, guys like Vlad figure that out pretty quick.
I think, again, it kind of comes down to, is this a new revenue stream and how sticky is it? I think, again, kind of going back to the visibility, having that true visibility is beneficial. I think where we've seen the market is, I'd say you look 5 years ago, SaaS and subscription businesses on the software side were probably trading a little bit higher than payments, and payments has had a nice run up, not only in the public markets, but more broadly. I think people are understanding the value of payments and the recurring nature of it. I think as we think about a recession or downturns, I think we think of the end markets more than anything when we think about payments. When it's a B2B transaction, Coca-Cola is not going to all of a sudden have less payments that's going to be flowing through their ecosystem. At the same time, if it's a mortgage end market or new car buying end market, there is going to be impacts on how that is impacted from consumer behavior. So I think we look at it in that sense, and we try to value that appropriately and risk weight higher volatility businesses accordingly.